I've done my best for you, doing best through this trails of love.
Now we come to questions number 4, Ben's company. So same thing, we need to do the adjustment. So this is all the expenses. Look at the adjustment. Inventory at 31st was valued at 45,000 based on the cost. However, 15,000 of this inventory has been in warehouse for 2 years and director agreed to sell it at a cash price. So means that, okay, in this 45,000, okay, so means that in this 45,000 is inclusive of this 15,000. But now this one, when is compare your IS, the inventory, okay, lower of cost and or net realizable value, then we know that this cost is higher and the net realizable value is lower. So we have to minus out your cost and use the net realizable value. So your closing stock in this case will be only 40,000. Okay. Now next one, marketing expenses include 5,000, which is related to next year. Because your closing stock is on 31st of March, but this 5,000 is next year, means that this is your prepaid. It means here you should have a prepaid expenses. So look at this, this is your marketing expenses, right? Marketing expenses 5,000. So here in your marketing expenses, here you will have a prepaid marketing expenses. So this is 5 and you're supposed to minus 5 from here, okay, from your current marketing expenses. Now next, based on the past experience, allowance for receivables is increased to 5% of the trade receivables. Check, do you have any other bad debts? If you don't have, then just directly times 5%. So look at this one, 5% times your debtors. So in this case, your debtors is 600. So 5% times your 600. Your allowance for receivables will be 30. Okay. Now, so here we have a bad debts, allowance for receivables. Yeah, allowance for receivables, you are supposed to increase 12 and in your this one doubtful debts is 12. Okay. Now next you will have this wages and salary outstanding 40 for the year, and the outstanding means accrual. So look at your wages and salary. Look at here, you have accrual of 40. So you should have accrued wages and salary. Okay. Now next, look at here, you have a depreciations 5% at cost, and the building were revaluated. Okay, after charging current year depreciation and director wish to incorporate into the accounts. Current year depreciation will be based on the old value after take place. Okay, so look at your current year depreciation. How much is this? It will be 5% times your depreciations for your building. So here you have your building. Building at cost is 705. So times 705. Okay. So you will have 32.25. This is your current year depreciations. And so here you have to add on your building depreciations. You'll have this. Okay, now I just add on here. You will have the depreciations. $32.25, and here you supposedly have to add on 32.25 as well. Now next one, the question say you have revaluations, right, to 1.8 million. So from 705 you revalue to 1.8 million. So now we have to calculate how much has been revalued. So before that we need to calculate the net book value of the cost. So 705, there's a cost for your asset minus accumulated depreciations beginning of this year minus current year depreciations. So the total net book value when you want to revalue the asset is actually 564. Okay, now your revaluations upward is 1,800 minus 564, so means that the increase in revaluation is 1236. So 564 is the cost, the net book value. So when you do your current year depreciations, okay, when you do your current year depreciations, the whole thing for this one, for your accumulated depreciations, you'll minus out and put it back to your revaluations accounts. Okay, so the total will be minus 105.75 minus 32.25. Okay, now then add on to your revaluations account. Check. Okay, see if you have any revaluations account initially. No, so just go for revaluations account. Okay, now your revaluations amount, you have these two amount add on. Okay, plus, and also you have an increase. You have an increase in your building at cost. Now, how much should you increase? If you look at here, is you have revalued to 1,800 minus 705. So you should increase 1095 here. So here you have an increase of 1095. Okay, bear in mind this should be on credit side. Okay, so plus 1095. So minus here, you add on to this value and also your revaluations increase. Okay, now next one, depreciations. Motor vehicles is 20% on written down value, so it will be 20% times, okay, written down value is 142 minus 28.85. Okay, 142 minus 28.85 times 20%. So your motor vehicles depreciation should be 23. And okay, for next is your machineries, 20% of cost, so times machineries times 200, so you have 440. Okay, so depreciations, one is 23, one is 40, so this one accumulated depreciation, here you have to plus 23, this one you have to plus 40. So when you have a depreciations here, you will have one more depreciations. It is for motor vehicles. This is 23, and machineries is 40. So here you have 40. Okay, and this one done during the year. Bonus issues 1 for 10 was made. Okay. So bonus issue 1 for 10. share premium account has been used for this purpose. So bonus issue, one share is $1. So total number of shares that you have. Total number of shares you have is 700 divided by 10, so you have to plus 70 because 1 share for every 10 shares. So now share premium minus 70, the balance you go to share premiums account, then here by 70 go to share capitals account. Now we can prepare the income statement by now. So let's see. First thing, you start from the sales of the accounts. Okay. Now sales, if you look at here, you have your current year sales and purchase. This is your sales amount. Okay. Next, so this one amount is done. So after sales, you should have your return. Yeah, there's a return inward here. So 54, you have to minus 54. So this is your return inwards. Okay, so this done. So you have this in total, your net sales is 2176. Now next one, you will have your stock. This is your opening stock. Okay, so opening stock is this amount 60. Then you have your purchase for the year. In this case, your purchase is 1750. So plus 1750 purchases. Okay. And so this is done. Purchases is done. Next, do you have any other expenses? There's no. Then if there's no, then you just lump it together. Then minus your closing stock. This is your cost of goods available for sales, 1810. Okay, cost of goods. Now then you minus your closing stock. Now just now already calculated your closing stock amount is 40,000. So here minus 40,000. Okay. So in total you have 1810 minus 40,000, you get 1770. So this is your cost of goods sold. Okay. Now then, if you have this cost of goods sold, this is your sales minus your cost of goods sold, you get your gross profit. So gross profit is 406 here, you have gross profit. Now next, after this, you will have your discount receipt. Just now I mentioned you have a discount here, 13,000 discount receipt. Okay. Discount receipt. Now after this, you should have all your expenses. So if you look at this, there's a lot of expenses here: insurance, general expenses, prepared, all these wages and salary. So all this is your expenses. We'll just put in. Okay. Plus insurance expenses. Okay, so if we look at this, this will be 165 in total. Okay. Now this one done, here all done. Then we go on. Doubtful debt is also your expenses. All these three is also your expenses, so just put it back. So these three also done. Now, loan note interest, this is also your expenses. Okay. And bad debts also your expenses. The depreciations for 3 building. Okay. This is your assets. Okay, so this is your total expenses that you have. Now, look at this, your total expenses. Okay, now your total expenses will be 605. Okay, so minus. Now your total income and minus again your total expenses, you have a loss of 186. So this is your current year net loss. Okay. Now we're going to prepare the financial position. So you start with your fixed assets, or we say non-current assets. Now in your non-current assets, so look at here, you have these 1, 2, 3 non-current asset, 1, 2, 3, 4. This is your cost plus your accumulated depreciations. Then you get your net book value. Okay. So if you look at this, your cost is 610, and this your cost will be 1,800 for this year because of the revaluations. Land has no depreciations, and also as your building has been revaluated, so it's the same amount for these two, 1,800. Then motor vehicles, if you look at your motor vehicles, this one is already, this account has been 0. This 1, 2, 3, 4 are done. So motor vehicles for this year, if you look at here, you have in total of 51. So total net book value is 91, and same go for machineries, total is 80. So net book value is 120. Okay, so in total here you get 2621. So this has done these two. Okay, now then we'll go for your current assets. Now in your current assets, look at this. You have cash. Okay. 67. Now next, so done. You have your, this is opening stock. You have your closing stock, inventory. Inventory should be just now already calculated. Your inventory is 40. Okay. Now next one, you will have your other asset, debtors, 600. But your debtors have to minus again your doubtful debts, provision for doubtful debts. So this 600, and your provision for doubtful debts just now we have calculated. Allowance for receivables, this one is 30. So 600 you have to minus 30. This is your allowance for receivables. So net will be 570. Okay. Then beside this you will have your, just now this is done. Okay. This one also done. Check. You have a prepared expenses. Okay, marketing expenses is $5. So prepared. So prepared is 5. So 1, 2, 3, 4. Total you have 682. Okay. Total asset will be 3303. Okay. Now next one you have your equity. So if you look at your equity, you should look at your shares. Okay, shares in this case, your share is 770. Share capitals, you will have 770 plus your share premium. Now, according to your question, share premium is 7. This is minus 70. Okay, so you have 30. No, so this one done. Okay. Now next, you have your revaluation reserve. Just now the account that we opened, revaluations account. this one. So in total, this is your revelations, reserve. In total, you will have 1, 2, 3, 6. Okay, and then you have your share retained earning. Okay, now look at your retained earning. Retained earning is 300, but this is before you minus off your dividend and also your loss for the year. Okay, so you look at this case, current year net loss is 186. So retained earning is your B equals to 186. Now equals to your 300 minus 186. Okay, and that's all. I think this question we don't have a dividend. So your 300 here, okay, minus your loss for the year. You have a loss 186. This one, net loss for the year 186. So 300 minus 186, you get your retained earning 114. So total for this will be 2150. Then you have your non-current liability. So in your non-current liability, if you look at this, okay, accrued expenses is current, bank overdrafts is current, creditors is current, loan notes, this is non-current liability, and so this done. And also redeemable. So if you look at here, redeemable share capital, this is also non-current liability. So you have these two, 550 in total. And the last one we'll have is our current liability. So just now we have checked through, we have this current liability for bank overdraft. Okay, bank overdraft. And also you will have the creditor. Total is 508. And you have your accrual. So this accrual is 40. So this 3 is done. Accrual, bank overdraft, and also debtors, creditors. So this total is 603. So in total, your total equity is 3303. So that's all done for your questions.